Should I dump stocks now? Ray Dalio's big debt cycle theory indicates that a once-in-a-lifetime depression might be on the way due to two factors. First, high debt levels, and second, political dysfunction. If you are interested in his theory, please watch our video dedicated to Ray Dalio's big debt cycle. In today's video, we ask a simple question. If you think a depression might be on the way, should you sell some of your stock portfolio now? We will look at this question from three perspectives. First, historically, is there any asset class that provides protection during both inflationary and deflationary depressions? Second, statistically, does trying to time the market work? Third, what do people like Warren Buffett say you should do? Let's begin. We might be facing a stock market crash, followed by either inflation or deflation and a depression. Whether you see inflation or deflation depends on if you live in the US and certain scenarios related to political dysfunction. Given these widely diverging possibilities, where can I put my cash now so that it is protected? Stocks, bonds, gold, commodities, what? In other words, historically, is there any asset class that provides a decent real return, even during inflationary and deflationary depressions? When we say real return, this means our money has grown in its ability to purchase goods and services like food and housing, even after you factor in inflation or deflation. Hundreds of professors and academics at Ivy League schools have without exaggeration dedicated their professional lives to answering this question by analyzing centuries of historical data. The answer I present to you now is based on primarily three sources. First, the writings of Professor David Swensen of the Yale Endowment. Second, a book called Investment Markets by Ibbotson and Brinson. Third, a book called A Random Walk Down Wall Street by Malkiel. If you are interested in reading these books, links are attached in this video's description. According to these sources, and many more, the only asset class that is almost guaranteed to protect you by continuing to provide a decent real return is U.S. equities. But this verdict comes with one important caveat. This verdict is only valid if you are able to hold onto your equity bet for a long time, that is, 20 to 25 years at least. Many studies have backtested a strategy of holding an equity portfolio for 25 years over every possible scenario, including scenarios which include the worst timing possible, like buying stocks just before the stock market crash of 1929, etc. The overwhelming result of these studies is that even if you have the worst luck in the world and buy at the worst time, if you are able to hold onto your stock portfolio for 25 years, you are almost guaranteed to still produce a nice real return above inflation. For example, this chart shows an analysis by Princeton professor Burton Malkiel. In this chart, if you can only hold onto your portfolio for 1 year, your range of possible outcomes varies between negative 37% and 53%. But if you can hold onto your portfolio for 25 years, your possible range of outcomes shrinks to between 6% to 17% with an average of a little over 10%. No other asset class can say it provides this level of hardy resilience against all manner of inflationary and deflationary events. If there is viewer interest, we can make new videos doing deep dives on other asset classes to show the proof for this assertion in depth. The intuitive explanation for this is when you buy most other asset classes, you are essentially buying into the value of an inanimate object like wheat or oil, or a financial IOU like bonds. With equities, on the other hand, you are purchasing an ownership share in the rewards generated by a team's human intelligence. This team of people coordinates labor and capital to produce something of value to society. For example, if you buy shares of McDonald's, the team at McDonald's can adjust the price of their hamburgers during periods of inflation and deflation, as well as their strategy to survive. This is why the returns on equity are so resilient. The returns, by definition, are intelligently adaptable. With other asset classes like commodities, this cannot be said. So, if you are a 21-year-old investor, the answer is obvious. The answer is keep buying and holding stocks through thick and thin for the long run. If you are older, however, or cannot hold on for 25 years, there may be a temptation to try and time the market by selling before the crash and buying after the crash. In theory, this sounds ideal. But in practice, it is not clear if this is actually possible. Academics have spent decades trying to see if certain highly talented people are able to reliably time the market by analyzing trading histories for the most celebrated mutual fund managers and Ivy League educated traders at the largest financial services firms in the world. Long story short, these academics found trying to time the market is almost guaranteed to backfire and just lower one's returns and increase one's transaction costs. In a nutshell, the argument boils down to this. Do you believe index funds statistically outperform actively managed mutual funds? This has been the overwhelming conclusion of the investing world for decades. If you believe index funds are superior, let me ask another question. If market timing was established to be a talent which people could consistently use to outperform the market, then why don't mutual fund managers just time the market in order to outperform index funds year after year? If market timing was possible, the entire concept of index funds being better than mutual funds would break down. Finally, research is all well and good, but what do successful practitioners say? What does Warren Buffett say? Active trading attempts to time market movements, can destroy the decent returns that lifelong owners of equities would otherwise enjoy. Anything can happen anytime in markets, and no advisor, economist, or TV commentator, and definitely not Charlie nor I, can tell you when chaos will occur. Market forecasters will fill your ear, but never fill your wallet. Warren Buffett thinks trying to time the market is a horrible idea. In conclusion, if you think a depression is on the way, the best thing to do is stick to your guns and hold on to your stock portfolio for the long run. Don't try and time the market. When a market crash does occur, it takes a lot of courage to hold fast and resist the panic-driven urge to sell. If you feel fear, perhaps it might help to think of this analogy from Las Vegas. There is an old expression in Vegas, the house always wins. Since casinos ever so slightly stack the odds in their favor, in the long run they are guaranteed to make money. When a whale comes into a casino and takes the casino for $20 million at the tables, casino managers do not panic. They just try to keep the whale gambling because they know eventually the odds are in their favor and sooner or later the whale will go belly up and the casino will get their money back plus more. The thing to remember is when you buy U.S. equities, you become a part owner of the American casino, the American economy. You become the house. The stock market crash is the whale. The odds are stacked in your favor, so don't panic. Just hold on and eventually the whale will go belly up and your profits will resume coming in.
This video was sponsored by Stream.com. Stream is the world's best shopping list app. Stream believes life should be simple. Stream's shopping list app features a simple design, and it's super easy to share a shopping list with friends, family, and coworkers. Try Stream.com today. That's STRIIM.com. Thanks for watching. Please like, comment, and subscribe.